Okay, let's get started today. We are going to talk about the loanable funds model of credit markets. I've distributed a handout and it's got lots and lots of pictures on it. Here's how that's to be interpreted. There's a row of 1, 2, 3, 4, 5, 6 graphs across, and those all work together, and that's it, okay? And that is our basic model. What you can see is there are two demand curves. There's a demand by the business sector for credit, and there's a demand by the government sector for credit. Over on the right-hand side, there are three curves. There's a supply of credit by banks and the Federal Reserve, associated with the creation of money. There is a supply of credit coming from households, associated with household saving. And then there is a supply curve associated with foreigners who are lending their savings to people in the United States. Would you pass this back to that student? All the way. Then what we do is we take all those three supply components and add them together, and right in the center of the graph we get the total supply of credit. And we add those two demand components together, and in the center we get the total demand for credit, and so that's where the interest rate is determined. This is what we did last time in class. Now, here's what we're going to do, and I already got a little start on that, and we'll run back and review. What we do is this, though. Our basic model is those 6 graphs across the top. And so what we're going to do is we're going to move down the page, and in each instance, over on the left-hand side, there are some words there, a little label, and we're going to say, suppose this happens, whatever this event is on the left, and then we'll trace through the effects on the market. Okay, so I'll kind of sketch these briefly, but you should be able to follow this as we go across. We've got these demand curves by business and the demand curve by government. The total demand in the center. The supply curves from the change in the money supply and the change in the credit supply coming from the Federal Reserve. We've got saving by households, and then we've got a supply curve from foreign lenders. And we add those three supply curves up and we get the total supply. And then the total supply and the total demand for credit determines the equilibrium interest rate. So this is the basic model. And then I put a dotted line across the page showing here's how each sector goes into determining part of the total supply and total demand for credit, but then each sector is affected by the total demand and the total supply of credit, affected by whatever that interest rate is. Okay, and so that's what that dotted line is for. Now, what we'll do, and I briefly ran through it last time, what we'll do is say, what if, okay, and the first one is, what if the government deficit increases? What would cause that to happen, first of all? Well, the deficit is equal to government spending minus tax collections. And I told you before that that's really not 100% accurate, minus all sorts of revenues received by government, mainly tax collections, but there are some fees and so forth, some licenses that generate income for the Treasury. So it's really all the government's outflow, all of its spending minus everything coming in, but most everything's taxes, and so that's basically how we summarize that. So how would the deficit increase? What could cause that to happen? Answer, either the government could spend more or it could tax less. And then the deficit would increase, and what we'll do is we'll show this curve shifting to the right. Deficit, okay, and I'll put a 1 there next to that because I'm going to put numbers, labels to these, so you'll be able to walk your way through the process. So the first part of our analysis is the deficit increases because of some policy. We're going to build an aircraft carrier and borrow the money to pay for it. We're going to build a highway and borrow the money to pay for it. We don't have to borrow the money. We could raise taxes. But if we don't do anything to taxes and we spend more money, the government, then the deficit increases. And so then the second thing we see is the total demand for funds goes up. And then, other things being unchanged, that gives us a higher interest rate. 1, 2, 3. And then what we can do is trace that higher interest rate, the effects of that, on the economy. And so here's one effect. And we'll come back over here. Right? Higher interest rate. So here's number 4, less borrowing by businesses to finance capital investments. Why do they do that? And the answer is interest rates go up, the discount rate goes up, the cost of borrowing for business goes up. Some of these investments that they had contemplated, some of these investments they were going to undertake, oh, let's build onto our restaurant, let's get a new delivery truck, whatever. Some of these investments are no longer feasible when we have a higher discount rate. And so then we say no to some of those. Okay? Somehow or another, we know this. If the government's deficit increases, I'm going to put a number here, if it increases $100 billion, that $100 billion has to come from the credit market. It's got to come from someplace. And so part of that $100 billion that the government's now borrowing, some of it's going to come from, basically, it's going to come from the credit market and it will never make its way into the hands of businesses. How much? I don't know. $10 billion less in investment, $20 billion, $50 billion, $75 billion? I don't know. It depends on the situation. But some of that will not be borrowed by businesses. By the way, we've got a term for this. Crowding out. That is to say, when the government borrows more, it crowds other borrowers out of the market. That make sense to you? Like if I go to the market and buy milk, let's say I don't buy milk normally, and all of a sudden I go to the grocery store and I buy 100,000 gallons of milk, there's going to be less milk in the grocery stores. And somebody is going to get crowded out of the market. Somebody who normally drinks milk is going to say, you know, I'm not going to drink or eat maybe cereal this morning because I didn't get any milk at the store yesterday because they were out. Or something like that. Anyway, here's the thing we say about crowding out though, and it's a little bit different than this idea of milk. Crowding out explicitly means businesses that were going to borrow to purchase or to invest in capital goods, factories, tools, equipment, new technology. Somebody who was going to go out, or businesses that were going to go out and borrow the money to do that, now they won't. And so as a result of this, we're going to have a smaller capital base, let's say smaller industrial base, in the United States, and that is going to result in less economic growth. And so when the government goes into the market and starts borrowing that money, you can think, hey, you know what? I love that new highway they're building. I love that new aircraft carrier. And I'm not saying you're wrong. What I'm saying is that as economists, what we want to do is understand, hey, what are the effects of that? And the answer is, if the government goes out and does these things and borrows the money, then what happens is there's going to be less investment in the private sector, and less investment means the industrial capacity of our private economy is going to be less. And then we're going to pay down the road for that. Should we pay for that? It might be worth it. It might be that 1/10 less percent of economic growth, you know, the economic growth rate dropping from 3% to 2.9, maybe that is worth it, whatever it is that we're getting. This is not a situation where I say good or bad, only it's a fact of this money has to come from somewhere. Now let's come over here. The Federal Reserve's policy didn't change when interest rates changed, but here we go. Number 5. I'll put a 5 here. In our logical process, the interest rates go up, and so people save more, right? In response to the higher interest rate. Is that good or bad? It's not. We're not putting labels on it, good or bad. It just is. Now you remember that we had this thing before, disposable income. There's 2 things that happen with disposable income: consumption and saving, right? You've got this money that you earn, $100 a week after paying taxes, and now there's a certain part of that 100 you're going to spend, consumption spending, a certain part you don't spend, saving. At least you don't save it now. And so, if there's this higher interest rate, and as a result, people increase their saving, the other half of that is you still got this $100 income, and maybe before it was 95 and 5, 95 consumption and 5 saving. If now what you're doing is saving, let's say 8, not 5, then you're spending 92. They still add up to 100. And so when people increase their saving, they also decrease their spending. Now, I'm going to go on and talk about this next sector in a moment, but let's look back and see what's happened. Here's the government pumping this money into the economy. Oh, they're spending $100 billion, let's say, on projects of various kinds. This stimulates the economy. And I mean, that's what we read in the newspaper. We see experts come on television, tell us about this. Government spending this extra money, it stimulates the economy. Well, what we see here is that businesses spend less. Now businesses borrow less, they don't buy as much in the way of capital goods, and that offsets some of that spending that the government's doing. It slows the economy down, and not only right now, they're not going out and building, let's say, new factories, but also over the longer run, we have fewer factories, and so over the longer run, economic growth slows down. Here's something else that happens, though. Now that people are responding to this incentive to save more and spend less, hey, there's less money coming into the private economy. People are just not buying as much stuff. They're not buying cars. They're not buying houses. They're not buying clothing. And so this reduces the amount of spending in the economy. So yeah, we've got the government putting that money in the economy, more spending, stimulating aggregate demand, but now this is causing aggregate demand to fall off, less business spending, less household spending, causing aggregate demand to fall off. These are offsetting that government stimulus. And then finally what happens is this, and here's our number 6, is that interest rates go up in the United States and foreigners spend or send some more money to the United States in response to those higher interest rates. Usually they would be buying bonds, but not always. It could be some, let's say there could be a foreign bank, a Swiss bank with branches in New York, and so that Swiss bank, whose headquarters is in Switzerland, maybe what they do is transfer some funds to their New York branch and loan some money out to big companies in New York, Procter & Gamble. Okay? Or maybe what they do is buy bonds. Here are foreigners. Here's China. Somebody talked about sovereign wealth funds the other day in class. Ask a question. Here's somebody in another country, maybe the Chinese government. It's got a surplus, and then what they say is, hey, interest rates just went up in the United States. I'll buy some bonds issued by U.S. companies or maybe the Treasury. Okay? And so these are called capital inflows. Now, there's a little bit of confusion here. This is an investment. This is borrowing to pay for capital goods. And by capital goods, I mean tools, equipment, machinery, structures, software, things that businesses use to produce stuff. So there's that word capital. This is a different way of using that word capital. This just represents funds flowing into the United States from overseas. Doesn't mean the capital goods, the tools, equipment, machinery, structures. It just means funds flowing to the United States from overseas. And so we have capital inflows. Okay? Is that good or bad? It just is. There are huge capital inflows into the United States, not only to loan money in the United States or to buy bonds, but also to buy stocks. This is a great place. Foreigners like to invest in U.S. companies. General Electric and General Motors and General Mills and General Foods and all these companies that we have in the United States, foreigners like to invest in our stocks. And so there's a huge amount of funds flowing into the United States to basically to lend and to invest here. Okay? So anyway, these are the effects of that increased government deficit. And so when people start thinking about this, is this a good thing? There are some people, and I'm not here to tell you good or bad, but there are some people who say, you know, I see a mixed bag here. I see the government spending this money, stimulating our economy. The extra spending, like there will be jobs if, let's say what we're going to do is build an aircraft carrier and build a new highway and build a new hospital, a veterans hospital, and so forth. It stimulates the economy on the one hand, and then on the other hand, what happens is those higher interest rates cause the economy to slow down. Businesses aren't spending as much to build factories or to buy tools and equipment, machinery. Households aren't spending as much to buy cars and clothes and houses and so forth. And that slows the economy down. This doesn't slow the economy down, but this creates an obligation. Foreigners put their money in the United States, but in the future, they want to be paid interest, and in the future, they want to be paid back. And so there is a day down the road when foreigners will be saying, and I would say the same, so there's nothing wrong with this, but foreigners will be saying, hey, you know, back, 20 years ago, we loaned you money, time for you to pay us back. And so there's a day down the road when we're going to transfer wealth to overseas to pay these debts off. And so all this sort of stimulus that we get from the government, it comes at a cost. It comes at a cost today of less business spending and today less household spending, and then later on when we pay foreigners off, less spending then here in the United States because we have to transfer those funds overseas. Economists are always, got the scales here, benefits and costs. Okay, by the way, all I just described is these macroeconomic effects. There's also the microeconomic effect. If we build a new aircraft carrier or a new road or a new veterans hospital, those things themselves provide service. And so you might go, you know what, I hated what you're saying, but we need that aircraft carrier, we need that road, we need that veterans hospital. Okay? And then at the same time, those factories provide a service. Those factories are not now building. The service would be, they would create jobs, higher wages, economic growth down the road. We're going to miss out on that service. And those cars and houses and clothes that we're not going to buy now, those provide a service. And so, it's a mixed bag. Everybody weighs this differently. There'll be people come on TV and just say, this is absolutely a great deal, and those people mean from their point of view when they put it on the scales. And other people tell you this is lousy from their point of view. There isn't an answer. But I'll tell you what, there's not a logical way of weighing these things unless you know the effects. And people who just come on and go, boy, we need that aircraft carrier, we need that road, we need that whatever, so this is okay. I always listen to see if they've got the scales out and if they're aware of these other things. And if they're not aware of them, they always think it's worth it. And the people who only talk about this, are they telling you how great that aircraft carrier is? We need that. The one that we've got out there in the Mediterranean is wearing out and it's got to be replaced to defend the nation, blah, blah, blah. If they're not aware of that, then they don't have their scales out. Okay, so anyway, that's what we're doing is we're going to go down through here and take other examples. Second example, let me erase here, of how this model can be used is, what is it? An increase in the savings rate. The savings rate, that would be households, and by the savings rate, what we mean is the percent of household income, disposable income, that is saved. Okay, so if there's an increase in the savings rate, what happens is, and by the way, here's what I said, the savings rate is saving over income, disposable income. And so if the saving rate goes up, what that means is, here we had that income, and it can go into two things. For some reason, people decided, I want to save a bigger proportion of my income. And the way we would show that is by shifting this curve to the right. Okay? The first step in this process is to shift that curve to the right. Now, why does saving increase? And the answer is, there's not one answer. There are multiple answers possible. Okay? And I'm going to spend several minutes on this, talking about why that saving rate can change. Here's the first one I want to talk about. There is a day when you are born, and then you are age 0. And how much do you save that year? And the answer is nothing. Quite the opposite. Everything you consume when you are a baby, you're really borrowing. You're not saving anything. You've got 0 income, and you've got consumption. So you're negative on the saving. And it goes on that way for years. And there's a certain point out here, and I don't know exactly when the point is. It might be for a typical person. Maybe, I don't know, you get to be 20 or something like that, and maybe you get to the point where you're able to save a little bit. Maybe not, right? You could still be in college. And you could be spending money in college, and what you're spending is more than you earn. And then you know what happens is you graduate from college, and you go get a job. Maybe you say, oh, I'm making $30,000 a year. But then they tax that. And then you go out and you say, well, you know, I'm just going to work. I got to rent an apartment or a house. Got to get a new car. Got to get some clothes. Got to take a vacation every once in a while. And maybe you're spending everything you got then. So then you go on for a while, and then you meet the perfect person, and you get married. And then you have a baby. And then your baby cries because that baby's got to be fed. And then that baby's got to have clothing. And the baby's got to be taken to the doctor. Then the baby starts getting clothes, and then the baby outgrows those clothes the next day. And then the next day outgrows some more, and the next day outgrows some more. And then the baby's riding a bicycle and then bangs his or her, knee, and you take them to the doctor. Then they get into school, and then they get, you know where this goes, right? And lessons. Then finally that baby goes to college. And then, oh my God, it's going to cost, $20,000, $30,000 a year to send the baby to college. And you're just spending and spending and spending. And you're going, oh my God, when am I going to get ahead? Now, I don't mean to say there's never a penny saved, but what will happen very often is people will save some money, for a year or two and then spend it to buy a car or something like that, and then those savings are gone. But when you start really contributing to savings, I mean putting something away that's meaningful, for most people, and I don't mean to say everybody, but a significant amount, and I mean to say put it away for years, not for some very short time, is about when you're 40, 45 years old. I know that just sounds ridiculous, but it's true. Okay, now, everybody saves, throughout your life. Every time you get a paycheck, like if you get paid today and you don't spend some of that for 3 weeks, you're going to save that for 3 weeks, part of it. But in terms of putting it away and not pulling it out of there and leaving it for years and years and years, decades, people get pretty old before they do much saving. And then they just save and save and save. I remember going home. I was in grad school, and so I went back home. My brother was still living in the same town as my parents, not with them, but in the same town. And so I go home, and my dad's, he says, I got to mow the yard, and he goes out and he gets on this sort of big tractor kind of a thing. And he's mowing the yard. And I could remember those times when I was growing up. He'd say, oh, mow the yard. I'd go out there and I'd get behind some kind of a deal, and I'm walking along like this and going up a hill that seemed like it had about a 80-degree incline on it. I'm working my butt off to mow that yard. Now I go home, he's driving a tractor. And they're buying new cars and stuff like that. I'm thinking, where did all this money come from? Did somebody die and leave you money? And I'm asking my brother, and he says, oh, they're spending money like you can't believe. And I say, so I go to my dad. I say, where'd all this money come from? He said, you and your brother are gone now, and so we have money now. We didn't have money before because we were buying you cars and sending you to school and supporting you. And now that you're gone, we have money. That's life. And so what happens is, someplace along around 40, 45, you start putting some money away, and boy, you save a lot. And then you get to a point at maybe about 65 or so, and you say, hey, I am going to retire, age 65, and I'll just put that out there. All of these things have some, variation to it from one person to the next. And then what happens is you retire and your income goes down, and you keep on spending. And so what happens is, you're starting to deplete those savings. And so this is really a life cycle that we have. And people that get to be 65, 70, 75 years old, they tend not to spend as much because they already had their house paid for. They don't feel a need to go out and buy a new car all the time. Right? They don't have expensive hobbies, probably fewer trips to Vegas, where there's a lot of drunken gambling, kind of stuff like that. And so their income's down after they retire, but their savings way down too. And so a lot of people, when they're retired, they're still saving something, but not nearly as much. So anyway, and then what happens is finally you die, and maybe you've exhausted all those savings, and that would be my goal. Actually, my goal would be to exhaust them 5 years before and just borrow money and then die, and then let somebody else deal with the debt, the lenders. Anyway, so there's this life cycle. Now, here's the thing, though, and how it plays into our story. Let's just say, and this is not true, but I'm going to say hypothetically, let's say hypothetically that there's 1 million people born every single year into a society. 1 million people born and 1 million people die every single year. Then what there would be is 1 million people at every 1 year interval along this curve. And so the people who are saving a lot would be, like these people out here, they would drop off 1 million a year, and then there would be 1 million of these people come on a year. And so I guess what I'm saying to you is this, is if we had that steady state population, then it would not affect this curve at all. The saving would always be the same because there would always be, at whatever point you are along this curve, there would always be somebody to replace you. As you move to another point on the curve, you'd be replacing somebody else, and so basically our savings would be the same amount. That's not true, though. Here's what we had. We had a baby boom generation. 1946 to 1964, there were 78 million people born. And that, it's called the baby boom generation. The population was booming during those periods. And basically, you can, to understand that, you go back to 1929 through 45, and what we had was a depression during this period when the birth rate fell off, and then World War II, which went on for several years, and millions of young men overseas during that period. And so, and when you take the young men and leave the country, you don't have the essential ingredients for having babies. And so, basically, during this period, the birth rate was very low. And so, anyway, when World War II was over and these millions of young people came back, and we weren't in the depression, there wasn't the poverty, but more prosperity, people started having babies. 78 million people born, the most ever in U.S. history, and I think that record is still maintained. And so what happened is this, is we had this huge number of people who were, in 1946 through 64, a huge number of people that were down here that were not saving much at all. But what's happened is those people got older and older, right? In 1946, in 2006, these people were 60 years old. And what's happened then is you've got from what would it be if you add, 40, let's add 40 to this, 1986 through 2004, what you have is the baby boom generation crosses this mark, the first ones in 1986, and by 2004 they've all crossed this mark where they're doing the savings. And so you've got the baby boom generation up in this area now. All baby boomers are in this post 40 or 45-year-old group, and they're all doing a lot of saving. And for the most part, now there are special people, some people who will retire at age 30 or whatever, but for the most part, the baby boom generation, they're not retired yet, and they're in this high saving part of their life cycle. And so when we come back over here and I say, hey, the saving rate increases, what could cause that? It could be caused by something like this, a bulge in the population, and then that huge number of people get into the point of their lives where they're doing a lot of savings. Now, here's what happened later. What happened later was the birth rate fell off. The population, or the number of births, fell way off. It went way up, and then it fell way off. And then what happened was those baby boomers, when they were about 20, 25, 30 years old, what'd they do? Well, you know what they did, because a lot of them are your parents. They went out and had babies. And so what happened was the huge number of people here, and they had babies, and then we had a lot of births again. So, in your generation, there's a huge number of people. And then the people, in your generation are, 40, 50, 60 years old, there'll be a huge amount of saving again. And in between these two generations, the baby boomers and the baby, whatever you call yourselves. What do you call yourselves? I know, smart, generous, kind. In between, there will be this point where there's not much saving. And so now these are not things that happen overnight. It doesn't happen like on Monday there was a big savings rate. On Tuesday it fell. On Wednesday it picked up. These are things that happen over time. But the point is that that saving rate can move by vast amounts over time because of these population trends and knowing about this life cycle. Okay? So there's one answer. It could be that the saving rate increases because the baby boom generation ages and gets into the high saving part of their lives. Okay? What else can cause a lot of saving? By the way, here's not the answer. The answer is not interest rates go up, because the effect of interest rates is captured by this curve. It's got to be something not interest rates that would affect saving. Here's a possibility. What would happen if there's an increased life expectancy? Suppose somebody came out today and said this, hey, we've got an announcement. We have cured cancer. Here it is. You take this pill, you won't get cancer. Or here's an operation, we can kill cancer. Or here's some genetic fix, we can, drive it out of your body. Or if somebody else comes out and says, hey, we got this new device, or we got a new operation, or we've got a new drug or whatever, and it gets rid of heart disease. No heart attacks. And cancer and heart disease are the two things that cause the most deaths. And so if somehow we came out and made significant strides, and there's all this genetic engineering that's taking place and research and so forth, if we made some huge stride on improving life expectancies, then what would people say? They would say, oh, I was going to work, let's say from age, 22 to 67, should say work. I was going to work during those years and save something and then spend that until I die. And I don't know when you die, age 80. So I got 45 years to work and save whatever I can during that period. Pardon me? And 13 years to spend it. On average. Some people are going to die earlier, some later. You think you live to be 80? Yeah. Not every single person, but yeah. The average life expectancy is a little bit less than 80, but The reason the average life expectancy is less than 80 is infant mortality. You know, is there a certain percent of population that die within just a few weeks of birth, and that keeps the average down. But if you get to be your age right now, then you should live to be 80, and maybe more. So anyway, yeah, and only 13 years to spend it, but you're really not going to save for 45 years. You're really going to save for like 20 years. I already told you about that. Save as long as you want, but statistics bear this out is from age 45 to 67 you save, and then you spend it. Okay? So anyway, what happens if you said, I'm going to live to be 90? Then you say, oh my gosh, there's 10 more years in there. Now, you know what you could do is say, Social Security will take care of me. Yeah, say that. And try not to laugh, because here's the deal. If you live to be 90, not 80, Social Security will take care of you. And if everybody lives to be 90, there's a lot of people that are going to live an extra 10 years and be collecting those benefits. And you know what somebody's going to say up there in Washington? They're going to go, you know, we need to do something about this. We need to give them the same amount of money as we were going to give them before, but just half as much each year. Yeah, you get the same amount total of money, half as much each year, or something like that. They're going to have to reduce those benefits and increase the taxes to manage the Social Security system. So Social Security is not going to be the answer to this. Here's what you'd say. Hey, we're going to live longer. We got to save more. Unless you want to live in poverty that extra 10 years. So, save more. So, increasing life expectancy, and we don't snap our fingers and go, well, we just cured cancer. But what happens is this. Gradually, over time, we are finding ways to basically fight disease and so forth, illnesses, and to extend life expectancies. Life expectancies go up a little bit every year. And as life expectancies go up a little bit every year, then that creates a need to save more to tide you over during that period, and that pushes that curve to the right. Our saving rate goes up. How about this one? Let's talk about the effect of social programs. Social safety net. And what I mean by this social safety net, these are government programs. What I mean by this is government programs to help people out at a time of need, sort of like a rainy day. Here's a simple one. You've heard of this. If you've got a job, your company lays you off, you go down and register for unemployment benefits, right? Those unemployment, and they are not generous benefits, but those unemployment benefits are the kind of thing that we're talking about here, this safety net to keep you from just falling into abject poverty if something goes wrong in your life. But we have other things than just that. There's Medicaid, where we have a program to provide health benefits, and they're not vast and generous, but they're benefits for people who are poor, right? And we have food stamps, and we have aid to families with dependent children, and we have, well, a variety of these types of things. So we had this safety net to help people who are in need. Now, how does that affect us? Let's just take the typical person. I've got this job here at the university. I've never been laid off, don't expect to, I have tenure. But suppose they told me, hey, we're changing the rules. And here's the rule. It could be, we're not guaranteeing one way or the other, but it could be that money will be a little bit tight here, and if it is, what we're going to do is lay you off for one semester. And then you can come back after that, but we're going to lay a random number of people off, faculty off, each semester because we need to basically tighten our belts. And then what I'd start thinking is this, oh, well, I hope that doesn't happen, but I can go down and register for unemployment benefits if that happens, and so I get some money coming in. Well, what if that didn't exist? What if I had to face this possibility of being unemployed, and there's not unemployment insurance, unemployment compensation? then I'd be thinking this, boy, things could go bad. I better put a little something away just in case. Because if I don't have anything in savings and I get laid off, how am I going to eat? So what I'm saying to you is this, is that what this safety net does is it says this, if there's a rainy day, if you run into bad times, somebody's going to help you out. The more generous that safety net is, the more help you can count on, the less you need to save. But if the government would come back due to, let's say, financial exigencies, financial problems faced by the government, and they said, you know, we want to help you, but we just can't afford it. And so what we're going to do is we're going to take 10% of the benefits away for being unemployed. We're going to take away 10% of the money for food stamps. We're going to take away 10% of the Social Security benefits. We're going to basically roll this safety net back. Then people would start saying, boy, maybe I ought to save a little bit more just in case something goes wrong. And so what I'm saying is a generous safety net says don't save as much. And a less generous safety net says, you better save. If things go wrong, it's going to fall on you. And so a less generous social safety net might be something that would shift that curve to the right. Okay. So anyway, and we could come up with different possibilities, but things like this, for us to come up with different possibilities, it has to be something that has a big impact. You know, something that would impact millions and millions of people or hundreds of millions of people in a meaningful way for it to shift that curve very much. But those are a few examples. Suppose that the savings rate, though, increases for any of these reasons or any others that you could come up with. Okay? If the savings rate increases, that's step one. Step two is there'd be a larger supply of funds. And step three, the interest rate would go down. And that's the end of the what happens directly in the market. But then there are consequences of that. Okay? One consequence would be with a lower interest rate, businesses would borrow more. Here's number 4. Businesses borrow more to finance new factories, new tools, new equipment, new machinery. We get a larger industrial base in the economy. And then what would happen is over time there would be more economic growth. Here's number 5. Over here, interest rates go down. I guess I didn't run this all the way across. Interest rates go down, and we borrow less from foreign savers, foreign people, governments, individuals, and so there is a smaller capital inflow. And what that means is we're not going to have to pay back as much debt in the future to foreign lenders. Questions about this?
So would more jobs be created with the economic growth?
More jobs would be created, yes. What would happen is there'd be more factories and more whatever office buildings. And so, and just all the things that go into making a business operate. Be more oil derricks in Texas and so forth. And yeah, and then there'd be more jobs. And then over time, what would happen is we'd have more economic growth.
So less unemployed people, so savings would go down, and then it just have an opposite trend.
Less unemployed people, so savings would go down. No, savings would go up. And I mean, that's what got all this started, right? Savings went up.
Right, because unemployed people were putting money back.
I don't know where you're going with this, but I'm not going to go with you.
Yeah.
There would be more people with jobs, and they would save. Okay? Anyway, are you with me on this? Let's try number 3. And let me erase before I do number 3. Or the third example. The third example is increase in the foreign supply of credit. That is to say, let me come over and shift this curve to the right. Step one, the foreign supply of credit increases. Foreigners want to loan more in the United States. What could cause them to do that? How about this possibility? Maybe foreigners, and this has happened, foreigners experience prosperity. Their incomes start going up. And as their incomes go up, they say, hey, let's save some money. And when they say, hey, let's save some money, although of course they would be saying that in a foreign language, let's save some money, they would save some money within their own country, and then they would also, some of their savings would come to the United States. They'd say, let's buy some treasury bonds, for example. That's one of the things that could cause this. Right? And so, Chinese prosperity over the last generation, they have generated huge amounts of savings. And out of that huge amounts of savings, a fraction of it, but a huge amount of money has come to the United States and pushed our interest rates down. And here's the lower interest rate, number 3. And then as a result of that, there's more businesses have access to credit, more borrowing, larger capital base in the United States, lower interest rate. There's number, what would it be, 5. Households say, hey, lower interest rates, we're going to save less and spend more. Right? You remember, we've got this $100 worth of income. If at first we're spending 95 and saving 5, and now we save less, only 3, we're spending more, 97. And the way this shows up is people go, hey, interest rates went down, I'm going to buy a new car. Hey, interest rates went down, I'm going to build onto my house. I'm going to buy a new house, get a larger house. And there's a considerable amount of evidence out there that vast amounts of saving in China over the last generation, especially the last 10 years, vast amounts of saving in China, some of that worked its way to the United States. All of that saving from China that came to the United States pushed interest rates down, and then people said, hey, I can afford to buy a house. And people bought more houses than they otherwise would have. Okay? And this is a capital inflow, but caused by some event overseas. And there are other events overseas that could cause this. Exchange rates could change and different things like that. Okay? We have a couple more examples. We'll talk about those next time. So long.